Good afternoon, everyone, and welcome to this edition of Credit Cracks, Interest Rate Paths, and the 2025 Fixed Income Playbook. I'm Smriti Popenoe, the co-CEO of Dynex Capital. I'm joined today by my brilliant and experienced colleagues, TJ Connelly and Bob Nilson. We're going to talk to you today about the interest rate environment, stuff we see in the credit markets, and what we're thinking about in our 2025 Fixed Income Playbook. I'll start off with introducing TJ and Bob. TJ, why don't you introduce yourself?
Sure, thanks, Smriti. I run the investment team at Dynex. Before joining Dynex, I had a 20-year career in the hedge fund industry. And before that, over 25 plus years ago, I cut my teeth in the bond markets at Freddie Mac, JP Morgan Asset Management, and Capital One.
Wonderful. Bob?
Yeah, thanks. Again, I'm Bob Nilson, and I serve as the Chief Risk Officer here at Dynex. Over 30 years of experience, I've developed a deep background in loan level credit across many asset classes and numerous market cycles. That experience has given me a unique perspective on where risk resides and the need for rigorous scenario analysis and focus to maintain a mortgage portfolio.
Mm-hmm. Fantastic. So, guys, a lot has been going on in the market since the April 2nd tariff announcements. We've seen a ton of volatility in the bond markets and the equity markets. Why don't we start by talking about interest rates? Interest rates are foundational to the valuation of so many asset classes. TJ, what's going on in the rate markets? Is fixed income a viable alternative here for portfolios? What are some considerations that people investing in fixed income should be thinking about here?
Yeah, absolutely. As you point out, there's been a lot of noise in the markets. Effectively, you look back to the tariff announcement on April 2nd, and just those 5-day trading days after that, we saw the 10-year yield trade all the way down to a 3.8% yield, back up to a 4.6% yield. Those are the kind of moves that at points in our career we were seeing over the course of an entire year.
Right.
And so there's a lot of noise. We need to keep in mind the bigger picture. And that's two things. One, real yields over the last 5 years have gotten higher and higher. And real yield is just the yield that's available in the bond market relative to the inflation rate. So that is much more compelling for investors. And second, the yield curve. So short maturity yields are lower relative to higher maturity yields. And that's been a big shift. So those two drivers, I think, are the important things to remember when you look at all the noise we've seen.
So it sounds to me like if you were just, dropped from planet Mars onto Earth right now, you'd look at interest rates and say, wow, you're actually getting compensated for taking risk for longer maturities. And in the shorter maturities, you're actually receiving compensation for things like inflation and growth. Is that accurate?
Yeah, absolutely. The shorter maturity yields are, appropriately priced, and the back end of yields, so those longer maturities are higher in yield, in part because of various things. But we break them down into, the fundamentals of the market, the technicals of the market, and the psychology of the market. And those three factors have really resulted in this steeper yield curve.
So in general, then, fixed income looks like a viable investment alternative and could be potentially something that investors use to diversify their exposure. I mean, there's been a lot of volatility in stocks, and you've seen a lot of Mag 7 rotation in and out, and so there's some uncertainty there as well, given all the geopolitical stuff. Is fixed income really a diversifying tool here for investors?
Yeah, diversification is the most important thing you can think about as an asset allocator, right? It's the only free lunch in the marketplace.
Right.
And so when we think about diversification, yes, fixed income, for the reasons we just talked about, higher yields in general, steeper yield curve is a much more compelling diversifier for portfolios. The other thing I'd say is the segment of the market where we spend a lot of our time, obviously, is in the mortgage market. So mortgage yields relative to other fixed income assets are notably higher, and that's what we're doing. As you know well, we're trying to extract that spread. So that's an additional diversifier. So not only is there the opportunity for investors to allocate to fixed income broadly, but then you can allocate to specialists who are providing, tremendous amount of dividend yield by trying to earn that spread that's available in mortgages relative to other fixed income assets.
Yeah, that makes a lot of sense because, just a few years ago, your checking account was earning zero or very close to zero. And now it seems like, you're able to earn more just in terms of short-term rates. And it sounds to me like we have at Dynex found an opportunity in the mortgage sector. And those yields are very compelling at this point relative to history.
Yes, exactly. Those yields and those spreads, right? When we
Yes.
look back many years, and we've had a huge shift, a major shift in the marketplace from when the Fed was buying mortgages and held those spreads very tight. The yields on those mortgages was very low relative to treasuries, for instance. We were down to, let's say, 1% treasury yields and less than 2% mortgage rate at times. Those levels have shifted dramatically. So now we're looking at 150 to 200 basis points, 1.5 to 2 points higher
Yeah.
per year that an investor can earn in mortgages relative to treasuries.
And for us, I just, there's an advantage there too. You mentioned the shape of the yield curve, right?
Yes.
So for an investor like Dynex, we have an advantage in that, you're earning the asset yield, which is kind of benchmarked off of the long end of the yield curve. And then we're financing in the financing markets, which are in the short end of the yield curve. Talk about like how that spread being wider now is actually generating some investment opportunity for excess return.
Yeah, absolutely. We're buying the mortgages that are somewhere on, let's say, a 7 to 10 year life and financing them with the short dated financing markets. So we're taking advantage of that steep yield curve, as you said. And the other piece of this that's very hard for investors who haven't been doing it as long as we have to do is to hedge that interest rate exposure. So
That's right.
when you hear about a yield curve trade like that, what's compelling, where an additional edge comes is when you're able to do the hedging like we can. And that's what's so unique to the value proposition. And that's why this is a really interesting diversifier, because it is different than some traditional fixed income.
That makes a lot of sense. I mean, it feels like, again, we're investing in this highly liquid agency mortgage market. We're financing in a very liquid financing market, and we're hedging, with highly liquid interest rate hedges. And so there's a big sort of liquidity up in credit, up in liquidity thought process here at Dynex. And I want to turn it now over to Bob Nilson to really kind of talk a little bit about the credit environment. Dynex, we went up in credit, up in liquidity in 2017. We've not really allocated a lot of portfolio exposure to credit per se. Give us your views right now on the credit environment. Let's start off with the commercial real estate market. What are we seeing in the commercial real estate credit markets?
Yeah, absolutely. So one of the foundations of our disciplined risk-based approach is to closely monitor numerous markets to remain connected to the developments and the credit trends that are shaping the markets and driving returns. So to your question specific to commercial real estate, I'd say the market is in general adjusting to the higher interest rate and cap rate environment. What that means, though, is that can translate into a more challenging time for loans that are facing maturity to effectuate a refinance. Okay. And so a refinance involves revaluing the asset, resizing the loan amount, and resetting the rate and the term of the loan. So given the tight lending conditions we're seeing now, this might require a borrower to put additional cash into a deal, which is something that generally speaking, borrowers don't want to have to do when they extend. So on that maturity side, you hear a lot of talk in the markets about a wall of maturities.
Yes.
You do. And so for 25, for example, about 2/3 of the loans that have reached that maturity have been refinanced, which leaves another third of those loans just outstanding.
Okay.
Okay.
And so what happens to those loans?
I'm sorry. Yeah. So that pressure, that's increased the number of loans that have been modified. Essentially, a modification is when a servicer and a borrower make a determination to delay or a foreclosure type event today in hopes that the property will perform better down the road and the environment will lead to a more refinanceable environment.
Yeah. And I think the key word there was hope, which is a tough way to have an investment strategy. I think a lot of it we're also thinking through in terms of the valuations on the 1/3 of the loans that aren't getting refinanced. These are tougher properties where there aren't really comparables. So,
Yeah, there's
commercial.
another piece there as well. I mean, so the modification is not always going to avoid or mitigate a loss, but with the market where it is, it can be an attractive way for the servicer to maintain some cash flow, and to also avoid the time and expense of the servicer having to foreclose a property, assume control, stabilize the asset, and sell it. So ultimately, it comes back down to when the servicer is going to make the decision. Are we better to operate this property perhaps in that tertiary market, to your point?
Yeah.
Or we want to let this borrower who hopefully has more local experience work it out down the road?
Right. And so it sounds like the commercial real estate arena, credit arena, which is a place I know it's been super public. A lot of companies with exposure to this asset class have had to take losses. That's not been a place where we've allocated our capital, and it sounds like the cracks in the system are still there, and there's not yet recovery happening. Why don't you talk about the multifamily space? I mean, we've been, we talk about Dynex Capital as operating at the intersection of Main Street and Wall Street, and a big part of our investment thesis in housing has been this massive demographic trend that's driven the demand for housing. So how is that playing out in the multifamily sector?
Yeah, so to your point, the demographic trends around multifamily, support the investment. Not only the investment that we're making in those, but the investment that sponsors and other lenders are putting into the property. A lot of those sponsors and developers took advantage of the low rates over the past several years, and they brought a lot of units to market. And as we talked about earlier, with a higher interest rate environment, some of that supply is slowing down. Okay. Which has been favorable to what we call absorption, or the ability of these owners to release these units to apartments. So that number is starting to stabilize, which is a good thing. And finally, these more units are coming to market have put a little more pressure to slow rents down a little bit, but that rent growth is still positive. So it's a very favorable backdrop for investing on that side.
Excellent. And it sounds to me then like the cracks in the credit are really kind of sitting more in the office area, maybe potentially even in the retail area, like we've seen in the past. That hasn't changed. Multifamily seems to be supported by this demand for housing. Let's shift over to the residential credit side, TJ. What's going on in home prices? What trend has been there? Are there credit cracks happening on the residential side? And if so, like, where might those show up?
Right. We start with a very fundamental approach. And so when you think about residential credit, you have to think about the U.S. consumer first and foremost. And for that, we really need to go all the way back to the pandemic. We can't, even 5 years on from the onset of the pandemic, we're still seeing impacts on the economy. So you had a tremendous amount of housing activity in the initial days or initial years following the pandemic. And since then, things have started to slow down for sure. Existing home sales are dramatically slower. We are still seeing, and mostly because a lot of homeowners are in, and this is an important construct in the mortgage residential market in particular, a lot of homeowners are sitting in homes with mortgages that are very low, sub 4%, sub 3.5% in many cases. And as a result, you're not seeing a natural turnover of the housing market the way you used to. So the existing home sales market is very slow. Affordability at today's interest rates is an issue for a lot of borrowers. We are seeing some new supply come on market, but broadly, this is a market that is very much in shortage of new supply. So that's been an important consideration. There are pockets of markets where home prices are not going up like they were. California, Arizona, Florida, for instance, are seeing home prices start to stabilize, even come back down slightly. For the most part, the U.S. consumer is in reasonably good shape, but there is a lot of uncertainty. At the end of the day, the wallets of the American consumer depend on their jobs and labor markets. And so far, labor markets have held up, but there's a tremendous amount of uncertainty in this marketplace. And so when we put all those things together, the fundamentals, the technicals, the psychology, all the things we've talked about, the agency RMBS market to me is far and away the most compelling. We're seeing some opportunities for reasons Bob just outlined on the multifamily side, and the commercial side is more interesting. And the great part about, for me, being at Dynex is we still have a team that can do all that it is doing, all the credit work, digging deep and telling us, yeah, there's nothing to do yet on this in the credit market. So when I look at non-agency residential mortgages, for instance, they're just not as compelling. But that's a place we're watching very carefully, because there could be some really interesting developments in the coming years.
Fantastic. And so there's also been a lot of talk about private credit, right? So that's one of the things, like private equity really blew up, and now we've got this private credit space. Particularly in the housing market, we're seeing it in what I call like peripheral lending. And
Yes.
The peripheral lending is sitting where you're buying a home and with the intention to rent it, or you're buying a home with the intention to fix it up and flip it. So there's fix and flip loans, buy to rent loans. What are some of the credit considerations if you're an investor evaluating whether you want to do this? Where are the vulnerabilities or the cracks that could potentially appear here?
Yeah, I think
Yeah.
just sort of three that jumped to my mind, TJ. Sorry about that. And then I'll
Go ahead.
chime in. First of all, we have the valuation of the asset. Is it a model-based valuation, or is it more pro forma? The second thing would be, what kind of transparency does the investor have into the actual assets that are behind that investment, and to fully understand the risks, the second and third level risks they're probably taking there. And then lastly, the liquidity of the investment. We've talked a lot about that here, about how can you transact in that investment at or near the level where it is marked. So just those are the first three that jump in my head.
Investors often take liquidity for granted. You think about what some of the headlines we've seen just in the last couple months, for instance, and I think about where is the capital coming from for that private credit. And one of the places has been university endowments, so endowments, pensions, all sorts of things, but university endowments in particular have been in the news of late because they suddenly have a need for liquidity that they didn't anticipate at all. And so now they've got a tremendous amount of assets in this private equity and private credit world that they suddenly need, and they suddenly need liquidity. They need to sell. And what is liquidity? Liquidity is the price at which you can sell an asset, and you have a major allocation to assets that you don't mark to market. I've always operated in the mark to market world, where we mark to market our portfolios daily, even by the second. I think that's something that investors take for granted, and it tends to be very many years before these things build up and then come to a head where it becomes an issue. So we may be seeing that in the private credit market. So that's another area where I think there are potential cracks developing, almost certainly cracks developing in the private credit market broadly. But then when it comes to our markets, it's some of these peripheral credit markets, as you said, fix and flip, all sorts of different sort of strategies that get into the residential market are things we're monitoring closely.
I love what we're talking about here. I mean, what I feel like we've covered is that it's important for investors to think about their investment horizon. So if you are an investor putting capital to work for 10, 15, 20, 30 years, some of these less liquid strategies might make sense, but you have to plan for if and when you might need the money, and think about, the ability for the asset manager, or even for yourself, to be able to liquidate your investment anywhere near the price at which you think it might be marked at. So that's an important.
Exactly. And it comes back to diversification, like you started with a little bit ago, right? That's the critical piece. They don't have a diversification in terms of their liquidity profile.
Yeah, and just to tie it back to how we started this discussion, I mean, yields are higher, and yields in fixed income instruments are higher. You're getting offered some level of cushion return on your capital to help you navigate the volatility. That's exactly why we're invested in the things that we're invested in at Dynex. That's number one. I think diversification Number two was important, and we're starting to see while there's investment opportunity in the agency RMBS sector, that is exactly where we're concentrated. There's slowly a trend developing potentially in the multifamily market that we could be investable, that could be investable.
Yeah.
And then finally, this idea of dividends. We're in the business of creating dividends. We're in the business of creating long-term sustainable dividends for our shareholders. Dividends can and do cushion investors from volatility, and I think that's one of the other factors that are potentially underappreciated by equity investors at this time, and can be a part of a strategy where you're matching sort of riskier assets and maybe long-term duration assets and less liquid assets with, a more liquid dividend producing instrument like a fixed income mutual fund or Dynex stock or something like that.
Exactly.
So let's turn to our playbook, guys. So 2025 second half, there's a lot of stuff coming up. We've got the debt ceiling discussion. We've got fiscal issues. We've got potentially GSE reform, all kinds of stuff coming down the pike. What are we doing to manage the second half of this year? Why don't we start off with TJ? You tell us on the investment side, and Bob, you can talk about the risk side.
Yeah, broadly, you talk about those spreads and the amount of yield available in order for us to continue to support the dividend, which is another way of equity investors talk about margin of safety. Fixed income investors talk about yield spreads in the REIT world. Ultimately, that margin of safety is the dividend yield, and how do we continue to support that? The great thing is spreads and yields are significant enough that we can lean into that, and that's a very important construct. Number one. Number two is we expect volatility to continue. We're going to have continued headlines about everything from trade to geopolitics, a host of things that could impact the U.S. economy and bond markets. So we will get continued volatility. What we're really leaning into there is liquidity, holding those positions, right? We talked a lot about liquidity, more diversification in the portfolio. Those are important constructs. Getting into the nitty gritty, I think, that most of the tea leaves suggest on the fundamental side that the U.S. consumer is slowing. It's not a rapid descent, but labor markets are weakening modestly. I think the Fed will likely cut at some point later in the second half of this year, probably late in the year, and we expect the yield curve to continue to steepen. I think and to be sure, that's a consensus view. That's not something our listeners will be new to. So I think there'll be some volatility in that. I always remind ourselves, and Bob and I talk a lot about this, hey, it's a crowded trade, we sometimes call it. The great part about our model and at a REIT is we have all this additional yield spread to weather those periods of volatility more so than we've ever had. So I think it's higher yields remain, especially on the longer end of the yield curve. We'll likely see some Fed cuts, and spreads are wide and probably will stay wide for a good part of the second half of 25.
Excellent. Bob?
Yeah, so I think, TJ, I'm very well aligned with that. TJ and I spent a lot of time debating the risk versus the reward of the portfolio investments, our liquidity position, et cetera. And so I just emphasize again the diversification of the asset classes, the coupons, the prepayment stories when we're talking about agency mortgage-backed securities and how we can dial in on different pieces. So that diversification is key. The second, or actually probably more important than diversification, is the liquidity, our ability to fund our balance sheet, our ability to transact, our ability to buy and sell these bonds each day, and to maintain additional liquidity, quite frankly, on our balance sheet to deploy into better investment opportunities or additional investment opportunities as they come up. And then the third piece, which again we've talked about earlier, is just scenario analysis, planning for what may happen, how will we react, what is generally going to be our reaction to something like the debt ceiling, and anything else that happens in the markets, let alone.
That's probably the most important thing. If you remember nothing else from this call today, it's we don't predict, we prepare. So I have what I think, I commented on what I think may happen in the second half, but we're prepared for a host of scenarios, and we spent almost all of our time thinking about all those scenarios.
Yeah, I agree, and I would say one of the key things in terms of, as investors think about their own 2025 fixed income playbook, it's understanding that volatility is here to stay. It's planning for those situations where things that we call extremes or tail risks, knowing how that's priced into the marketplace, um, having a game plan for when those things do occur. I think that's massively important. Diversification, which is again something that can be forgotten, especially when markets are going up all the time. It's really tough to diversify when things just keep going up. So this is an environment where when you're experiencing volatility, that starts to become a bigger piece. And then having that cushion, we have the cushion at Dynex with the yield spread on agency mortgages relative to our hedges. It's historically wide. Um, Investors in fixed income can think about the real returns that you're receiving on fixed income securities here today. That's as high as it's been. So that offers again a cushion relative to other instruments. Um, what else is, we did bring up the word GSE reform. I think that's been a tail risk that we've all been focused on. It feels like right now, given what the administration has talked about, that the risk of the GSEs being released without a guarantee has diminished somewhat. Is there anything else to talk about with that process?
I think it's an important construct for investors to consider. The GSEs are government-sponsored enterprises that were created over 30, 40 years ago mostly to wrap, so to guarantee residential mortgages so that banks that were small banks, for instance, all over the country taking out or making mortgage loans didn't have to keep those mortgage loans on their balance sheet. There's more of a residential housing market than individual banks could support on their own. So we have this amazing housing finance system in the United States where the GSEs guarantee the credit, and so they guarantee the ultimate repayment of principal effectively. And that construct allows us to then have these bonds that are in portfolios ranging from your pension plans to your mutual funds. They're in your 401k and the bond allocation, those sorts of things. That's a really important construct. Over the years, the missions of those companies have evolved. They own very large portfolios where they were actually doing not just the credit wrapping, but also funding the mortgages. And that's evolved such that that's almost a very, very small part of their business at this point. It's allowed private capital like ours to be that funder. We do it better than government entities have. And I think that's an important, the really critical construct here as we think about, they've been in conservatorship since 2008, more or less, because in part because those portfolios got just too large on the funding side. The government has slowly evolved their businesses. And I think, the critical piece of it is they do have a link to the Treasury through a line of credit, that as long as that stays in effect, markets will be comfortable. And everyone we've talked to in Washington suggests that the administration is very much aware of that, of its importance, and the pristine nature of the U.S. housing financing system. We have the most unique housing financing system, and robust, not just unique but robust.
That's and it works.
Right? It works. Exactly. It works extremely well. Affordability would get dramatically worse if we didn't have the agencies. So they're a critical piece of the system. So bringing them out of conservatorship may happen, but I think it's going to be a very careful process.
Yeah, I agree. So let's bring it home here with just what the takeaways are for us. Again, we started this conversation to talk about credit cracks, interest rate pads, and the 2025 playbook. From what we see here at Dynex, we're looking at credit cracks in the commercial real estate market. These are known issues. We've been following them. It's still not a place where we think our capital should be invested in, but we're closely monitoring that. On the multifamily side, looks like we might be able to have some investable opportunities. That's on our radar screen. On the residential side, we're looking more into the peripheral areas where we see some possible credit cracks happen, just because, again, the U.S. economy, while it's doing very well, any slowdown in the labor markets or slowdown in the broader economy could have some vulnerabilities in those areas. But generally, house price appreciation has been excellent. And so there's a solid cushion there. Our big star of the show is still the agency RMBS market. That is an extremely investable and persistent opportunity. Yield spreads on agency mortgages are the highest that we've seen since the great financial crash relative to our hedge instruments. And so we think that's still a compelling opportunity. And that is what drives our investment strategy, to be able to raise and deploy capital into this market. And it's really the foundation of the sustainable dividends that we think we can generate with our shareholders' capital today. On the interest rate side, I think, TJ, you mentioned real yields are compelling, meaning in the compensation that people get for investing in fixed income securities is as high as it's been since 2008. That's compelling. Diversification was the other piece. And at the end of this entire conversation, I feel like there's really two things that pop out. One, diversification and dividends can help you cushion your investment strategy as you go through a volatile environment. And of course, as TJ mentioned, one of the core tenets of our thought process here at Dynex, we don't predict, we prepare. That's at the core of everything that we do. I'll bring it to a close here. I thank you all for your attention and look forward to hosting another event in the near future.
Thanks.